Tesla just reported first quarter 2024 results, and like I said in a video earlier this week, investors should expect the worst. I think this was about the worst quarter that I've ever seen from Tesla. There's things that we knew coming into the quarter, that deliveries were going to be down, production was going to be down, that prices were down, so likely revenue was going to drop. And analysts had adjusted their expectations accordingly, but Tesla missed analyst estimates, which is their best guess at what the quarter is going to look like, on almost every front. So I think it's pretty clear that estimates for 2024 are going to continue to drop. And I think the bigger challenge for Tesla is, what do you do now? Net income is down, margins are down, and at the same time, all those things are down. Inventory is building. That's actually the free cash flow picture. I'm going to get to that in this video, but you're building inventory as you're lowering prices. That means that demand is not what you would expect for a company like Tesla. They're going to have to make a decision. Do they want to cut prices even more to try to move product, or do they want to cut production? We may have gotten some indications about what they're thinking about, at least how much they want to grow production over the next few years. Sounds like Mexico is off the table. But I'm going to dig into everything that we've learned so far. The conference call has not started yet as I'm recording. So these are in my initial thoughts, and we'll see how things play out over the next few days. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video's sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So before getting into the report, I'm actually going to go to the market's reaction because this is really interesting. Tesla is always fun to watch after earnings are announced. And you can see here that as I'm recording, shares are actually up about 8% after hours. So I'm not exactly sure what traders are looking at that is causing them to bid up shares. But let's get to the report so we can look at the actual numbers. This is the financial summary, and this is the most important information that you're going to get from Tesla. Revenue was down 13% on the automotive side. Energy generation and storage was up 7%, and services and other revenue was up 25%. Management said that these two segments are going to be growing a little bit more than automotive revenue this year. But overall, this is still an auto company selling cars. Revenue was down 9% in the quarter, and gross profit was down 18%. You can see that this trend continues of gross margins continuing to decline, now just 17.4%. And that does include the impact of tax credits. I'll get to that in just a second. The other big number to look at is operating expenses up 37%. Now, this may be one of the reasons that Tesla did a 10% layoff last week, because operating expenses are just higher than the company can handle as far as what they're generating in revenue and gross profit. So this is going to probably come down over the next couple of quarters, but with all the investment that they're trying to do into artificial intelligence and Dojo and all these other products that don't really generate any revenue yet, these operating expenses are going to be really important to watch. So I'll get to the breakdown in those in just a second as well. Adjusted EBITDA down 21%. And here was the big shocker when I looked at the numbers. Free cash flow was negative $2.5 billion. This follows a quarter of positive cash flow, $2.1 billion. And you can see that things were a little bit light in 2023 early in the year. But this is a really, really bad quarter from a cash standpoint. So let's get to some of the more detailed numbers. I always like to pull out the regulatory credits when I look at Tesla's margins. So I haven't updated those charts yet, but I will in the future. That's going to make margins a little bit lower, more like 15 or 16%. The other numbers that stuck out to me was some of the operating costs. R&D was up sharply, nearly $400 million increase to $1.15 billion in the quarter. SG&A expenses, sales, general, and administrative, that was up nearly $300 million in the quarter to $1.37 billion. And that's how you get the total operating cost increase for the quarter that I talked about earlier. So the challenge is going to be, how much can you cut any of those costs? Do you want to be cutting R&D costs right now? Probably not, as you're trying to invest in new products that are going to be the future of the company. Are you going to cut sales expenses? That's maybe not a great idea when you're having problems selling your vehicles. So this is the catch-22 that Tesla is in right now. Here's the balance sheet. The one number to look at here, and I talked about this in my preview video, is the inventory number. $16.0 billion worth of inventory. That is up $2.4 billion from just a quarter ago. This is the impact of producing 40,000 more vehicles than they sold in the first quarter. When you're building inventory, you're taking cash from the balance sheet and you're moving it into inventory. That's exactly what we see here. I'll get to the challenge of this in just a second, but let's look at the statement of cash flows, because this is probably the more important thing right now. Net income, obviously down sharply from a year ago. And here's where you see the changes in what they call other, but this is really inventory changes, negative $2.7 billion. As a result, the operating cash flow from the business, $242 million. That is a fraction, less than a tenth of what they generated in operating cash flow a year ago. At the same time, you're still increasing capital expenditures. You're still building out capacity to build vehicles and energy storage products and all the other things that you need to be Tesla. And this is how you get to the negative free cash flow that I talked about earlier, building inventory and net income falling. And this really brings about the challenge for Tesla today is, what do? You have more inventory than you can handle or that you can sell to customers. They're having clearly a demand problem when it relates to the supply that they're producing. So do you discount those vehicles even more to try to move them through the system? Do you cut your production? Now you're saying, hey, revenue is going to fall and we're going to maybe maintain margins, but we're not going to be the growth company that we once were. Well, maybe investors aren't going to want to pay the multiple that you have to pay for Tesla today. If that's the case, it's really a rock and a hard place. And this is why it's difficult being a manufacturing company. You have to balance supply and demand. Tesla has never been in a situation where it has less demand than it has supply, but that's exactly the situation that it's in today. And I don't see that changing anytime soon because there's no vehicles coming out. There's more competition both in China and the US. And I'm not sure exactly what Tesla is going to do to drum up more demand. They gave at least some indication, and this will be something that probably comes out on the conference call in about an hour or so, but they said they have updated their future vehicle lineup to accelerate the launch of new models ahead of previously communicated start of production in second half of 2025. So what exactly does that mean? That they're going to produce something in early 2025 that we haven't seen yet? We don't quite know. These new vehicles, including a more affordable model. So maybe this is that $25,000 vehicle will utilize aspects of the next generation platform as well as aspects of our current platform. So apparently some sort of mixed product. And they also said that this would achieve less cost reduction than previously expected, but enables us to prudently grow our vehicle volume in a more CapEx efficient manner. This basically means that they're not going to build the new facility that they were planning in Mexico. They're going to utilize the existing facilities that they have, said that they can enable more than 50% growth in production over 2023 production levels. The purpose-built robo-taxi, which they did kind of allude to a little bit in this presentation, is also expected to be announced in August. We don't know exactly what that is, but they're talking about an app, apparently some sort of robo-taxi service, which I don't know how they're going to launch given the fact that they don't have regulatory approval to have fully autonomous vehicles on the road, but we will see exactly what they're planning and what happens over the next few months with that. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. So you can see the real challenge that Tesla is facing right now. They're making too many products. They don't have demand. And I don't really know how you change that going forward. It doesn't seem like they're going to refresh the Model S or the Model X. The refresh of the Model 3 was kind of uninspiring. Now they're going to come out with some sort of lower cost vehicle that's some sort of hybrid of the one that they were planning and the one that they already have. It seems like a bit of a mess from a product standpoint at Tesla, and the company's still leaning on these products that don't yet exist. They want investors to be focused on Robotaxi or Dojo or Optimus. I think all of these things are distractions, and we need to look at what the actual auto business is. Are they doing a good job being an auto manufacturer? And the answer right now is no. General Motors came out with their earnings earlier today, and results were great. The company generated a ton of cash flow. They're going to continue buying back stock. Shares for trade for about 4.5 times 2024 estimates. Now you go to Tesla, and I don't even know what the estimates are going to be after this earnings report, but shares trade for at least 100 times what 2024 profits will probably be. So this is an investment channel, and I'm not analyzing what Tesla is doing From a theoretical standpoint, I'm analyzing Tesla as a stock. Would I want to buy the stock today? And the answer to that continues to be no, because the automotive business is still in decline. That is the reality of the business. Yes, they can talk about all of these other products that they're working on that may or may not come to fruition in the future. FSD seems to be the thing that people are latching themselves to, but there are so many questions about that. We don't even know if they're going to be legally allowed to drive robo-taxis with no driver on the road in the next 3 or 4 years. Tesla has not shown that it is working with any regulator in any state, and I don't think it's possible in any way that the US is just going to allow robo-taxis to go willy-nilly and not go through any sort of regulatory process. So lots of questions facing Tesla. It will be interesting to see what they say in the conference call, but I wanted to get this update out as quickly as possible. I don't think there was a lot to like in the results. The free cash flow numbers tell the story. The inventory tells the story. And the fact that everyone else is coming out with new electric vehicles in 2024 and 2025 is only going to make competition worse. So what do you think about Tesla's earnings report? The market obviously saw something that they liked, but we'll see how things end up over the next few weeks. Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.